This is the backtesting session, the first of the new enlisters, and we've had quite a few for everybody else. This is February 4th, 2024. We'll be getting backtesting on the 12-minute chart of NQ. So this is what we do when we backtest. We scroll this thing right here, the price scale, we scroll it all the way in. So we can't see over here whether it's bullish or bearish. Nothing inside of here. And we go back as far as we can. Right. We start in June. If you guys want to follow along, you can. But we're on a 12-minute chart. We are here on June 1st at 10:30. So this is the New York session. Usually we start off with the Asian session, but it's fine. So what we have here, let me bring this down just so the recording doesn't catch the music. What we have here is just this last up move, right? That's it. Back here, we don't know if this came from down here. Neither do we know if this came from up there. We have no idea where this particular low came from. So this is blind back testing. No higher time frame, nothing. We're just paying attention to the current order flow that we have. So let me go through just a bit of the basics first. And we're going to go through this often over the next 2 weeks. And after that, no more. It's time to learn order flow. It's time to learn ranges. It's time to learn how to operate in the market based on a high frequency trading scale to be able to exercise that precision and get in and get out with whatever you need from the market. So we're going to start this from the basics. So what we have here, which everyone should know, is a bullish trend, right? We have higher highs and higher lows being created, right? On the way up, right? And should price reverse, you'd see a breaking of this low, a tap back in, another short, a tap back in, and another short, right? A tap back in, and another short, right? So let's just make these, let's give them colors. So the red is going up and the green is going down. And I'm doing this on purpose because some of you guys are in this mindset that because you see green going up in the candles, you immediately want to jump into a long because you see green going up. No. We make moves based on what the market does, the cycles that the market operates within, right? So for that matter, we have red up and green down, right? So if you look within here, let me just get rid of some of this right here. If you look within the bullish market structure, what you actually see is something we call swings, right? If you guys watched video 2 of the public playlist, you would understand that we have a low here and we have a high. And then we have another low put in and we have another high. So this is not swing high, swing low. That is ICT. DTFX is we have a high, we have a low. Sorry, we have a low, we have a high. We have another low, we have another high. When we put in that second high, what we have below us is what we call the previous range. What is the previous range? The previous range is not the low and the swing high. The previous range is the previous low that took out that high to the left and that old high together. So when you're drawing the zone, it's from the high to the low, right? Before price reversed and took the high. So it's the previous high and the previous low. I can't say it any slower than that. It's the previous high, right? And the previous low. And maybe somebody else might get confused. So let me just put it this way. High, low, high, right? We have that low, we have that high put in, right? Usually we broke up above some previous high that's back here to the left, right? That's what we call a market structure shift or market structure break or violation of a high. This is what we call the flip in the videos. It just price trades up above the previous high. It's flipping price, right? So when we're drawing our fibs, I need you guys to understand this because we get this a lot, and a lot of people will spend months doing this and not understanding that they are wrong. So look, we have this previous, let me just create something here just so it shows that we went up above it. Cool. So we have this previous high and this previous low before price traded up and broke it, right? That means that you're not fibbing the low and the high that broke the new high that broke the old high. That's what ICT does. This is what people who trade Fibonacci's do. I do not do this. I do not teach this. So what I'm actually showing you is the previous high and low as that range that I create, right? And after creating that range, I'm putting the Fibonacci, as you guys see, or the GAN, whatever it is you want to call it, because here's the fib there too. I'm putting it behind, well, that high right there, right? And this low right here. So it does not go from swing low to swing high. Where it actually goes is right here, from the previous high into the low that it put in, right? Before running back up above that old high. So that is what we call our zone, right? So that's just the basics of what we're doing when we talk about price trading back into the previous range. So as you can see, we have this high up above here into this low down below here. And we see that price ran its way up above that old high. Now that's how we mark out the zone, right? And we're anticipating price, as the playlist has taught, to trade into the 50% of the zone, right? We're expecting this to drop into that 50%. And we're expecting price to what? Now trade out of it. And the first target is the high that put in this low. But if you trade on the conservative side, which I do, and a lot of people think I don't because the system provides so many opportunities that they think I'm just scalping all over the place. I'm not. I take the 50% and I get out at the high of that zone, right? Because that's my 1-to-1. I'm risking the zone, the back of the zone. That's where my stop loss always goes. My entry is right here into the 50% of it. And I'm targeting a 1-to-1. So what's so powerful about this system in general, is that when we trade back in, by the time we leave out of that zone, we're already at a 1-to-1, right? And anything else is surplus. So this is how we mark out our zones. Now, what we have here is multiple zones. We have, and it's not just multiple zones, it's market structure. But the previous high and low in market structure is the zone. So what we have is a zone there, a zone there, a zone there, a zone there, right? And then when we break market structure to the downside over here with this low, we have a zone there up above from this low to this high. Now, this is not, again, I need to say this a lot of times for you. This is not the OT yeet. This is not that you're taking the high of here and the low of here, and now that's the dealing range, and then you go back up into premium there, and then you see it go into the OT yeet and then head down. That's not what this is. It's the same thing that we talked about on the way up. So what it actually is this low that was broken, right? And the high that broke that low. So what you see is this previous range to the downside. But as price continues to make its way down, we have another previous range, right? Why? Because we traded up above and then went back below that low. So that creates that previous range that's there. So likewise with the other side, we have multiple previous ranges as we're going down, right? So let me just reiterate the ones going up, right? And this should be natural if you know how to trail market structure, because this is a high, this is a low. 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 No market structure broken until where? Here, right? So when that breaks, this becomes the high right up above. And this, whatever broke before it started to run back into that range, is the low. So we have this high, we have this low, 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 right? That's what we call market structure, the highs and lows. But the zones are what it left behind when we kept going in the direction of the trend. It left behind an up move like this. It left behind an up move before we headed down. So once we traded back below the low of that up move and we headed down, That is now your previous range. It's very important that you guys understand this. So what we have here is highs and lows, as well as our zones, our swings. That's what we call it, right? Swing point. That means price put in this high and swung down to put in a low. After it put in that low, it swung back up above the previous high, right? It swung back up above the previous high. So we call this our previous swing. Not, I need you guys to understand this. It's not our current swing. It's our previous swing, okay? Our previous swing. Very, very important. And I'm saying this because a lot of people will spend a few months in here struggling and using it improperly, and then talking about the fact that it's the mentorship that's being improperly taught for them, when it's just that they have not taken any notes, they have not slowed down the videos, and they have not digested the material that's free for everyone on earth that can access YouTube. So the mentorship is not about teaching the things that are free on earth that everybody has access to. Okay? And I'm saying that as aggressive as I'm saying it, because you're going to see people over time ask some of these same basic questions and show that they have not gone through the videos. They're just seeking answers for you to teach them right now, and they have not actually gone through the videos line upon line, precept. You guys get my point. So now we have these zones, right? Now there's something else about the zones that people tend to skip over, or FOMO, thinking that they can do something other than what's taught. They can shortcut it instead of sticking to what's taught and learning to build on top of that. So what am I saying? You see this low that swings up into this high, and then we have this high that swings down into that low. You see that? It swings down there. And whenever we get this low, you could see a swing back above what? That high, right? So what I need you guys to understand is that when it breaks up above that previous high, you see the green high? That previous high, this low down below is not a valid or a protected low until we close up above that green high, that green line that encompasses the high that put in the low. It is not a protected or a validated low if we do not get a closure above that high. Likewise, right there, the next high, right? This low is not a validated or a protected low until we get up above that previous high and close, body close. You guys hear me? Body closures. There will be times where you guys get wicks up above these highs and we trade back in. If we get a wick up above this high and we trade back in, more than likely it's not looking to get back up here. It's looking to now go to the downside. Why? Because it's a failure to close up above the previous high with a body. You hear me? A wick. I don't care if the bullish candle, the wick went up above it and came back in, but the wick had a body at the bottom. No. I don't care if the next candle opened after the wick was put in and the next candle had a body closure, but the wick of that body closure did not go up above the previous high. No, it doesn't count. It needs to be a body closure up above the previous high, okay? It needs to be, no matter what. I don't care if the Pope tells you otherwise. I don't care if your mother tells you otherwise. I don't care who it is in your life. If it's to save your life, you better lose it. It's a body closure, right, y'all? A body closure. Very important. Those are little things that people forget and get margin call because they're chasing price and they're not chasing order flow. They're chasing what price is doing, and they're not chasing how to get in the vehicle as order flow is moving into the direction that structure is looking for, right? So we have that high there, right? Now we have that high there, right? Now we have that high there, right? So tell me, if price deviated from here and went in to put in a new high above this, but it was a wick, and that wick still did not get a closure up above this previous high when this high was put in, that other wick that was put in did not get a closure. Is that a valid low? Great. It's not a valid low. So likewise, when we talk about the bullish component of it, what we also want to address is the bearish part of it. With the bearish part, we have this low right here. And up here, a body closure happened up above here, right? A body closure happened and then came down and closed with a body down here. Is that considered a market structure shift or a market structure break or a violation of a protected low? In turn, looking for downside now. Anybody that says no, you better not. Yes, that's what that is. We call it a bearish flip. That's what you hear in the videos all the time. I don't like saying market structure break because so many people got different ideas of what a market structure break is. I only have one. It's a body. So when we're trading up above a previous high that's over here, and we see it break up above that, and now we're trading back into that previous range, right? We call this a bullish flip. What is a bullish flip? You have a low, you have a high, you have another low that what? What do we need the low to do, right? We need the low to close below that previous low in order to validate this high, in order to call that a protected high, right? So then we trade up above the protected high. The only time we could start looking for longs is after we get a body closure below and we validate this protected high. We trade up above it and get what? What did we say down below? A body closure up above that previous high. That's when we are now what? Taking that previous range that we started with, that we discussed, and we're looking for price to trade back into that range in order to continue trading higher. That is the basics of video 1 and 2. So we call that flip in there a bullish flip because now price is flipping and trading to the other direction. And we call this here a bearish flip. That's what's mentioned in the videos, a bearish flip. Now we're expecting price to trade back into what? The previous range. And then we begin looking for downside, right? So this is very, very, very basic, but the most powerful thing you could ever trade with in today's market. The most powerful. Nothing else is needed. Not your, because I don't use imbalances anymore because they provide too much drawdown. Not your imbalances, not your breaker that's back here, not whatever other stuff you believe, the inversion coming from over there, through there, from the time Tupac got shot back here. We're using the 92 inversion to tap into here, and it's not that. It's just the swings alone, right, guys? The swings, the swings, the swings, the swings. Oh, do we have a break? The swings, the swings, the swings, the swings. Again, this cannot be considered a swing, right? Unless we trade it below this low that put in this high with a body closure. And I'm saying it this slow and I'm saying it this repetitive because we have people who joined back in March of last year still asking questions about whether it's a body or a wick. Unacceptable. Body. So now let me take the fibs out and show you guys this with fibs. The value's there, the percent, and let's change the color. So you see, it's at the 50%, right? You see the next one is at the 50%, right? You see the next one, it's at the 50%, right? This is not, again, this is not the OTE 50%. This is the previous range 50%, right? So let me actually get back to this one. So look at this. We have this down move that traded up above and put in a high, right? And shifted back in to that 50%. But what happened here, and this is what a lot of you guys need to understand, just because you mark out a swing doesn't mean that it's going to hold. I marked it, so the market has to respect it. No, that does not mean it's going to hold. So you have that 50% that's there, and we trade below and break the low of that previous zone that we talked about, right? And what we end up doing, because one of your swings will be invalidated. You guys got to get used to that. So that's why you don't trade with insane size. What we have here is now that previous range that we talked about, right? Up there, because we broke the low. So that previous range, let's make this a different color. Make it yellow. You see the 50% of the previous range? Again, y'all, that is not your OTE 50%. That is the 50% of the previous range. Okay? So now that we know that it's the 50% of the previous range, as we continue to make our way down, you see, it's the 50% again of that previous range. Then we put in a low here, right? And it's the 50% of that previous range. And then then we put in a low here, and we trade back up to what? The 50%. And we target the low. Now, I don't target the low. I'm content with one-to-ones. I've taken an account from $700 to $89,000 in 2 weeks utilizing one-to-ones. So the whole idea that one-to-ones do not work is completely idiocy. And it comes from people who do not know how to trade. When you have a high win rate and when you have a high RR, that's a great system. But when you understand that more times than not, your system pays you almost 95% of the time, your system pays you on a one-to-one more than targeting anything else. Guess what you guys are going to resort to, right? A one-to-one. Because that's the money maker. That's the money maker. So this same exact idea that I'm talking about, right, guys? The same exact idea. This is not on a time frame, right? I'm talking about the market's cycle, the way the market moves. I'm not discussing a time frame. This has nothing to do with the 1 minute, the 12 minute, the 144, the hourly, the daily, the weekly, the year. Nothing. It's not completely tied to that. It's everything. I'm not even talking about a time frame chart. Go to a Renko chart. Go to a line chart. Whatever chart you want to go to. This is the way that the market moves. But is this reality? Does it always 100% of the time move this way? No, it does not. But in order for you to engage with the reality part of it, how it actually moves, you first need to understand the basic movement of it. Because in a healthy market, it's going to move and touch back into these 50%. In a healthy market. In an unhealthy market, it's going to have deeper mitigations to it. And those deeper mitigations, what I mean by that is that we trade up, we trade back in like that, right? Let's say that the high is here. The 50% is right here. We trade it all the way down into here and move back up to here. More than likely, when that delivers, you'll see a move back down like that. when that delivers. And now the low is broken that put in this high, but guess what? It never allowed you to get back in. Until sometime later on that it came back up to what? Tap into the previous range. So you first must become successful with what is already laid out here. Train your eye for it. You can any pair you want. Crypto, Forex, futures, stocks, bonds, whatever, commodities, anything. Go and use the 10-year minus the 2-year. Go whatever it is you want to use. Any kind of metric. Go and look at a chart of the speed of light. Go and look at a chart of the average income of Americans. Go and look at any kind of chart that has movement to it, that tracks data. This is what happens. Even your equity curve. Even your equity curve. It all is bound by structure. Okay? It's all bound by structure. Everything. No matter what it is, there's nothing that this does not apply to. There is no time frame that is exempt from this. From the tick chart, the 1 second chart, all the way up to the highest chart you can get to and back, it works on everything. But there needs to be reality with it. Some people think reality is this. We create a high, we put in a low, right? We trade up above that previous high. We tap back in to that previous range. And here you have some people, they want to get in there with their stop loss like this. Yet don't even know how to refine yet. Don't even understand the fractal nature of price and knowing when to find what? This flipped on the larger time frame, right? But this also happens within here. So now, if your stop loss, if you wanted a lower stop loss, if you wanted to achieve a smaller one, instead of having the stop loss that's back here behind the whole zone, instead of having a large stop loss like that, I don't know who's going to have a 218-point stop loss, but it's probably those people on the sleeping bag time frames. But you can reduce your risk. There are other videos that will come that will teach you how to reduce your risk. That will teach you what the POIs are within there that you can look to trust to take your entry, right? But we have to build on the basics because not everyone is there. Some people have admitted it, and I'm glad that they did, because I don't have to spend the live stream sessions tearing people up for something they should have listened to and done prior to this. So I'm happy that some people came out and said this, because now we can take this backtesting session and mix it with not only backtesting, but catching some of you guys up, just the same way the next 2 weeks will be. This is not to ask what a fractal is. This is not to explain any of that stuff. That stuff has already been explained. And if you went to just backtest all the times you saw a fractal, then you'll get an idea of what a fractal means. But stopping the whole group to address something that 90% of the group already got past ends up slowing other people down. And that's unfair to the people who put in time. So this video will be the end all be all for the person that believes that they do not have the basics in play. So let's get back down to our zones, right? So we see that these are highs and lows, right? With zones that are trading up, right? Anybody remember video 1 from the free playlist? I know some of y'all gonna say yeah, and y'all lying. Some of y'all gonna say yeah, y'all actually did study it. But we have this. We have a high in here. We have a low in here. Let's say this is the 1 minute time frame. We have a high in there. We have a low in there. We have a high in there. We have a low in there. We have a high again, right? And then we instantly put in a low, right? So we put in a little high right here. You guys can see that right at the white line? We put in a little line right there. And then we went to put in a low. We put in another high and we put in another low right here, right? That's where this ends. The low of that, let's say this is the 15-minute time frame. The low of the 15-minute time frame ended here. And what did we do after the low ended there? What did price end up doing? Price ended up trading back up above. But on the 1 minute, what you're going to see is a push like that, right? Just a straight push back up. Now, with this push right here, I don't know why. With this push right here, let me move this out the way. With this push that trades up like that, a lot of people are caught on the 1 minute trying to short this because they say you have a low and you have a high that closed up above the previous high, right? So when we trade back into the 50%, they're trying to short it back down. But the 1 minute is order flow that facilitates higher time frame structure. What do I mean by that? What I mean by that is you see the series of highs and lows that it's putting in, right? Within here. Then it goes to put in a low below that previous low, right? And then what do you see us do? What do you see us do with this? We end up pulling back just a little bit and then trading up like this. And now everybody is shocked. Oh my goodness. It was supposed to, that was a market structure shift. Why didn't it hold? Because the 1 minute is facilitating the pullback of the 15 minute. And when the 15 minute continues, more than likely from some 15 minute POI that's in here, but also an unmitigated 1 minute POI, we see price trade up to put in another high on a higher time frame. That's why video 1 is so important. It teaches you multi-time frame analysis. I don't care if you think you're not a beginner. You're a beginner to the eye that I have, the perspective that I have, and what it is that I'm teaching. So you need to understand the root of it in order to be able to see what's blossoming in the market, what we see as clear as we see it. You need to know the root of it. It's so important. Very, very, very important. So now what do we have up here? We have this high get put in. And as soon as this high gets put in, we have a huge rejection back down like that, right? Let's say you had a little something right there. And a huge rejection back down like that. Now, for the market structure bros, you see this low get taken out, right? You get a body closure below it too. Oh yeah, great. It's time to short, baby. Price trades back into that. Mind you, it's coming out of the 50% of that 15-minute POI, right? It goes back to the 50% of it. Because there's a double top here, it taps in and shifts away. and you see it go down here and you're like, oh yeah, it's going for sell sign. And what happens? I know y'all, a lot of y'all know it. I know it. We trade away and we'll beep right to the other side and then actually go down to wherever it is you were trying to time. But now you're afraid to take a trade because you over leveraged on that larger move, lost a huge amount of money, and now you're afraid to lose more. But we're not even going to get to that psychology part of it because that'll happen later on in the mentorship. So we put in this low. And after putting in that low, what do? We go straight up. Like I said, we get a little rejection there and then put in another high right up above there. Like that. Now, what we're still paying attention to with all of this price action from the 1 minute to the 15 minute is that the 15-minute swings still intact. That's the 15-minute protected low when we went to put in that high, right? And in order for us to say that we're bearish to go down, we need to at least take out that low. If we do not take out that low, we trade next to the low. I have a tweet from last year that I don't think anybody had liked when I originally posted it. And now you see hundreds of likes on it and stuff like that. But and this is when Stoic had me blocked, because Stoic, he always tells us that he didn't have me blocked, he had me muted. He said that I was talking too much about high win rate and all this other stuff. It was sounding unrealistic, so he had to mute me. So I'm always going to tell that story because he had me muted. But that tweet, it said that if price takes a high and trades back to that low and doesn't violate it, expect the high to get violated. Likewise, it's the same thing here. If price takes a low and trades back to the high that took the low, expect it to go down and violate that low. So all that is, in plain English, is bullish and bearish flips. So this is the basics of what the masterclass teaches a lot of you guys, teaches everyone who watches it. Not only that, let me just move this back here again. Not only that, but the same thing on the downside we mentioned. We're expecting 50% taps, right? Now, what you guys need to understand is that sometimes we don't make it back to the 50%. And there are times where when we do, you get a little doji that forms here, something like that, and then they go to take the high. So a lot of people get caught in these. And the main thing, the rule of thumb, I taught this in the free play, FREE, the free playlist. I taught this in the free playlist. Guys, give Rusty a follow. Come on, we back testing. What are you doing? What, you paying attention? Because you're going to be the person that's coming and asking why you keep getting clapped. Because in class, look at the way you're paying attention. The way you practice is the way that you're going to play. So the rule of thumb is that as we are creating these swings, right? What we are doing, and I continue to tell you guys this over and over again, usually in a healthy market, you have 4 to 6 swings before you can expect price to reverse. So we count our swings, right? This is not counting candles. I need you guys to understand this. This is not counting candles. This is counting your highs and your lows. Now, somebody that's smart here is going to say, well, aren't swings just down candles? Yes, it is. But you're not counting candles. The reason why is you're counting the swings and you're seeing how far you are in that move up before price begins to pull back or reverse. But the swings are relative to the time frames that they are from, right? So what did we say about this? We said that these are 15-minute swings, right? So that means that this, having 2 swings already on the 15-minute, we know that we often get 4 to 6 in a healthy market. So when you get into your POI back here, when you get into your IPDA 57 Stingray Lager, when you get into that over here, what ends up happening with this is that everybody sees a low in here before that high was put in. Everybody sees that low that's right in here get violated. And now, since an imbalance form coming out of this, everybody's like, oh, displacement, FVG with the breaker to the left, and wham, just yeeted. Because you had zero confirmation that price wanted to trade lower. If price wanted to trade lower from here, it would look to take this out and close, then trade back in here. So when you're on the 1 minute and you're watching those flash moves down and you see an imbalance open up, everybody's like, FVG. Everybody's ready to jump in on a displacement. Silver bullet showed up, all this different stuff. And then they still get cooked. Because IPDA 1117 back here, it tapped in and they mentioned that it respected it. But no confirmation was given. We trade with confirmation. We don't just trade because price is tapping into something and we expect the sell side now to be taken out. We're trading with market structure. And when that structure is broken, that's the only time we change our idea of where we believe the market is going. Now, it's not that simple, obviously, because everybody would be a millionaire if they understood this. Now, can this basic knowledge here make you profitable? Yes. That's where most of those people who are on Twitter, you see them killing it, absolutely destroying the market with free information, never joining the mentorship because they find the ability to trade within these little market cycles. But if they're being honest with themselves, they know that it gets difficult and it gets tricky when we begin to what? Range. So they have their, let me actually just go up here. They have their highs and lows that are being created, and they get in here, and now they see this. They see a low get taken there, and then they see a high go back to get taken there. And then they see a high get taken there, and now they think that we're bullish, and then they see a low drop back into there. And now we going up there, and they believe that we're bearish, and they see price go back up above there, and then trade back into that low there. And all you see is something like this. Sorry, all you see is something like this. You're in a range. But you can't make sense of the little structure that it's making in there, and a little structure in there, and a little structure going up there, and a little structure going down there, and a little structure going up there. Oh, it looked like it flipped. Yeet, no, it didn't. Oh, it looked like it's going for the draw. Yeet, no, it's not. Oh, it looks like it's going for the draw here. Let me see if I can get in and get higher prices. Yeet, price drops down below. Because ranges are the only things that end up making it look a bit different. But even in a range, it's still the same. Now, we already sent you guys a video on ranges, tops and the bottoms of the ranges. You guys will see more of that in real time. Nothing is better than real time. You will see a lot more of that and understand what to do just by observing the narrative when it plays out. When it plays out. So the thing you have is your highs and lows, market structure breaks, bullish flips, bearish flips, the 50% of the range, and counting your swings. You have that. That criteria is no imbalance needed, no break or block needed. No, nothing of anything else that's designed from somewhere else and built into some other system needed. It's not needed at all. And in fact, if you choose to hold on to it, it's going to slow down your learning, because what we are trading here is light years ahead of anything you've ever seen, no matter who has refined it. I don't care what mind you believe. Right? What mind you believe is brilliant and made this, and this is the... No. You don't need nothing else. You don't need your standard deviations. You don't need any of that. You need to know how price looks before you are engaging with your entry. Period. All the other bells and whistles come later on. So over the next 2 weeks, you guys need to understand this. You need to backtest this. You need to refine this. There are times where it will not tap into the 50%. You need to allow that to happen. If you try to skip ahead and start using advanced material like the 30 or the 70, you will get cooked. They will smoke you up. So this is the basics of the strategy that we teach. Now, there are more refined material. There's more refined material that's coming, but you gotta get good with this. Nothing else but this. Okay? Nothing else but this. This is a quick summary and recap of video 1 and 2. Now that you have that, it's important to get back to the playlist, because the stuff that's explained there, you need it to build on. The stuff that's explained inside of there, you need it. You can get rid of the imbalance part. You don't even have to listen to it. Skip over that. I don't trade imbalances anymore. But the stuff that's explained, you need it. It is very important for you guys to have, because you cannot build new stuff on top of zero foundation. You didn't even create the foundation yet, and you're trying to pile more stuff on that. You know what they call that? A dumpster, a garbage can, a hole, something you just drop in. That's a dump. This is about creating something that has a structure to it, and it keeps you as the trader in that structure. You guys hear me? It keeps you as a trader in that structure. When you tilt and FOMO, the system is not FOMOing. The system is not tilting. The system doesn't need any psychology for it to play out. It will play out the way that it is taught. If you backtest it, learn to see it, learn to engage with it, that is 50% of your win rate right there. What I just taught you guys just now is 50% of your win rate. So when I first started trading, there was a mentors group that I joined, and he said his win rate was 30%. 30% wasn't enough to change my situation. 30% wasn't enough to remove that eviction over my head, to feed my kids. None of that. 30% would have destroyed me. As a trader, my psychology would have been gone. If I learned to trade and be successful 30% of the time. Now, I don't care about the whole RR thing. You guys are going to say, oh yeah, well 30% is still, possible to be profitable with a good amount of RR. That's not what we're focusing on. We're trying to focus on stopping you from losing. That's the first thing. You can only exercise good RR based on winning. If you have a 2% win rate and you have an average RR in the wins of, let's say, 6, 7, or 12, but you have a 2% win rate, how many times are you going to have to lose in order to finally win something? That takes away from your mental capital. That takes away from your decision making later on. That hurts your judgment in the process. So you need something with a high win rate. And then RR comes after that. After you have found enough experience in the market to be able to enter, to feel the confidence of pressing the button and seeing price get to your target, the RR comes later. The winning needs to come now. Not the RR, the winning. And you guys already were told that 1-to-1s is what you guys should consider. 1-to-1s. So let me bring this back some. And now show you when this market structure shift happens here, right? Or when this market structure shift happens here. So that's both of them. The bearish went up here, the bullish went down here. When this happens, what's often occurring that a lot of people are not seeing, and I already addressed this in the first video of the playlist. That I'm dead serious when I say that everybody on the planet who has access to YouTube has access to that free information and can change their circumstances forever if they just were diligent with it. But after that low is taken, let's start with this bearish flip. After that low is taken, what you often have is something that's unmitigated just below that low. That price taps into and brings you back into that previous range, right? It's something just below that low that it finds its support on and push back into that previous range, right? Oftentimes that is a down candle. Oftentimes that's a little 1 minute bullish flip that happened in here that price never came back to tap into, but you saved it for later, and then you saw it later came down and pushed off of it and still gave you the 1-to-1 out of the zone, even if the 50% wasn't tapped. But still later came back and delivered that 1-to-1 to you. So beneath every low, very important, beneath every low that's taken, right? There is something unmitigated just below it that causes the market to trade back into that previous range, right? There is something below it unmitigated. We run that low, tap into something else, violating both this low and the low of the zone, and we tap into something lower. And you see price make its way what? Back into where? The previous range. So that's where these moves come from. The moves that initiate the pullback. Because then the moves that initiate the continuation happen from the zones, right? Happen from the zones, right? So, likewise, when we flip up above like that, again, it's something up above here that it taps into to provide that move back into what? The previous range before it begins to trade up again. So that was a lot of information that I just gave you guys. And that information needs to be back tested so much that you know it more than your mother's name. You need to back test it and burn it into your brain, what you discover with the data that you are using. Burn it. Because it's going to save your life. It's going to save your account. So, if anybody has any questions about stop loss, that means you didn't watch the playlist. Because in video 8 and video 7, we've already taught that if you're shorting from a zone, your stop loss is behind it, unless you know how to figure out what? How to refine it through what? Video 4. So anytime you trade back into the previous range, where's your stop? Right behind the zone. We tap into the 50% and you're targeting what? Either the 1-to-1 if you are learning. And if you're greedy, and that's not enough for you, while you're learning to make money because you still can't get a grasp on consistent profitability, you're going to target some more, and then it's going to come right back to break even for you. So I need you guys to understand, your stops are behind whatever zone that you have chosen, right? So if this is an hourly zone, if this is a weekly zone, if this is a yearly zone, your stop loss is behind that yearly area, that yearly high, for you to tap back into the 50%, right? And then short, not your OT yeet 50%, right? But back into the 50% of the previous range. So those are the basic rules of trading this system. Now, you might see me sometimes take a long while somebody else is taking a short down into there. You might actually see me take a long somewhere inside of here. And then the market drop further down to there. And a student is in a short while I'm in this long right here. It's all about preference. This environment, this kind of system provides you with what? The obvious, the short, the long, 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 the short, the long. You see how all the way through you can trade every bit of it. But you have to know where you're expecting your counter trend versus where you are expecting your continuation. And if you're trading on the side of the trend, your continuation is up above. It's not. This is what people need to get. When you're trading on the side of the trend, it's not, oh, we tapped into the zone and you saw it go here and you said, okay, yeah, let me open up a short there. Because if we end up putting in equal lows and we trade back up, now you're getting cooked chasing price here and your stop, your invalidation is up there. Assuming more risk than you need to. Because chasing price for what? Because you were late, you got a phone call, you didn't see it, and then something happened, and then you saw it actually going and it missed the alert, and then now you said, okay, yeah, you know it's going down now, so let me try to get in, and then you see it go back up the other way. Yeet! So many of us have been in entries where this has happened. Not even understanding, right? Not even understanding that when they tried to chase the low and take price lower, and we broke below that, and we tapped into something unmitigated there, that unmitigated portion was enough on the 15-minute time frame now to tap here and now begin to what? Put in another high up above here. Boy, so many of us been in entries where we chose to remove our stop loss and we knew price just had to go lower and we did not get in at a good position and we watch price, boy, just carry us to our funeral because of chasing. So we have a little motto that's here. If you're not there for the tap, then that trade, if you got in up here, if you got in there, if you got in to go long there, if you got in, that trade is cap. If you're not there for the tap, that trade is cap. That trade is nonsense. That trade is foolery. It's a bag of foolery for you to be in, getting in, thinking that you have enough money to take another high over here, and you're getting in up here, and then we put in a wick at that high and then fail and go down that way. Very important. This is not a system that creates the need to chase. When you backtest and you refine, you learn how to get involved with the things that leave you behind. When you backtest and you refine, you learn to get involved with the things that leave you behind. It's not chasing to get involved. It's learning how to get involved within the order flow of price and what it's reaching into based on the higher time frame, and knowing that the position that you're in is not one that price is looking to come back to and trade below, down to your stop loss, come back to and take you out at break even, then go to where you're anticipating price going. I've never done an in-depth beginner's sort of display presentation like this, as in-depth as this. Carry a couple of videos across one explanation. But guess what? This explanation is not enough, because the backtesting portion of it and the videos that are on YouTube, they teach you about trading up above specific candles. They teach you about what area you should look for when we're pulling back to look for that long. They teach you how to refine that stuff. And we also have material here that's going to help you guys to understand that. But guess what? That material cannot be released, and it will not be fruitful for anyone who does not first learn how to do this one thing, and it's follow structure. So I keep telling people, you can become profitable with one move, with one entry style. For me, my whole trading journey came from one move. I only teach one thing. Just one. I'm looking for one thing alone. You guys know video 4? Video 4 was the only information that I had to find profitability. The only information that I had to become profitable and save my situation was video 1. That's why sometimes you see me using the wicks, and then sometimes you hear me say, oh, the wick is manipulation. That's what I was learning. Now I know always a wick, period. No matter what. If it leaves you and you found no way to get in, you couldn't get in. Your experience barred you from getting in on that move. Accept it and wait for the next setup, or else you're going to get burned. This is a system that requires discipline. It is highly precise. You guys already know that. That's why you joined. You understand that. You join because you understand how precise this is. And if you can just learn how to find that precision, then you can just get in the market, 2-3 times a day and live your best life for the rest of your life. If you can just figure this, that's what the market is. I'm sorry, I can't advocate for working jobs. I can't. I know other people do. I can't. Why can't I? Because I know the power of the market. There's no way that I could understand how powerful free money coming out of a market is, and I'm telling somebody to go settle for a job. Absolutely not. I can't do that because I already came into the power of what the market can do for a year. 1 year. 1 whole year. You give it your best. You give it your all. You will never feel any struggle again when it comes to trading. If you give it that 1 year, it will be a turbulent year. It will be, trying. It will be tough. It will be confusing at times. You might go through ups and downs in your emotion. You might feel depression, anxiety, whatever it is, but give it that year. Because guess what? When you were working at your job, and if you're still working at your job, you went there when you were sick. You went there when you were tired. You went there when you were heartbroken. You went there when you were happy, when you were angry. You went there, every single emotion that you experienced. You went there, and guess what you did? You did the job. You did the job still to the best of the ability. You still did the job. And guess what? They still treated you like you was nothing while you were giving them everything. Everything you were giving them. So this is something for you guys to backtest. Now we're going to go over a lot more of this throughout the next, few sessions, but this is what you guys are missing. Some of the people who are honest, and I'm glad you guys were honest about not watching the playlist. Some people come in here and lie. Somebody wrote to me and was like, hey, I watched the orientation video, but I don't know what to do. Boy, you... I don't know what to do. I watched it. Sir. So let's get on over here, because we're gonna get back to some of this stuff another time. But that's video 1 and 2 summarized. You still got to see it in real time, because again, it doesn't always look the same in real time. It doesn't always. That's what I said. It doesn't always look the same. So what do we have here? We'll do a little bit of back testing, and then I'll let you guys go back into the videos and stuff. What do we have here? So let's start with our structure, right? We know that this swing from this low to this high and back to here, right here, right? We know that that belongs to a higher time frame. How do we know that that belongs to a higher time frame? Well, if you look at this low that put in the high, by the time we returned back to the low, right? How much time had passed already? This is a day and 4 hours. That passed already. If we go to, let's say this swing inside of here, right? If we go to that and we look at the low that was put in after, and this is in video 3, by the way, so throwing in a bonus for you guys. We see that that's an hour, right? You guys are seeing this? Let me just zoom in a little. We see that this is 1 hour, this swing, this low down here into this high up here. That's 1 hour and 12 minutes. The one over here is a day and 4 hours. So we understand that from this low to when price came back and put in another low, that whole swing belongs to a different time frame, not this one. So what we have here is we have a larger swing here, right? And then we have a series of smaller ones that are heading down inside of here, inside of that one leg. So when we look at it, we have this low, we have this high, and then we close below right here, right? So that's the first swing there, right? This is the second swing right here, right? We go over. This is the third swing right here, right? We trade back below. That's another body closure there. You have this fourth swing right here. And then we have this low put in, right? So we got 1, 2, 3, 4. Cool. What we have here is a range. What do I mean by a range? So in terms of trailing your highs and lows, remember what I said? You have to trade back up above the protected high in order to consider yourself bullish, in order to consider this an actual flip. You have to trade back up above that high and close, right? So we see that this is an equal low down here, right? Not even an equal low, but a triple low. We know that when we get these environments here, especially within these ranges, with the failure to go below, we know that what that's telling us is that price doesn't want to go down anymore. It's now looking to try and trade up and what? Take out some highs, right? Now, we don't know what highs exactly this move up might take out. We don't know if it's going to trade back down below again. We have not back tested this at all. This is just a random. We usually do the 1 minute, but this is a random 12-minute grab of it. So the first thing we see here is this previous high, right? Now, whenever we have this kind of move here, I told you guys, as we are making our way up, that's when you start to see those imbalances forming to push price higher, right? So what you guys know is I don't use imbalances anymore. It provides too much drawdown. Sometimes we go all the way down into here before making our way back up there. If this was a 4-hour imbalance and I got in here at the early portion of the imbalance, then that's a 4-hour dip that I'm in before price actually trades that way. So if we get one 4-hour candle coming in and the next 4-hour candle coming out, that's at least 8 hours that I'm waiting inside of that drawdown before price actually starts to trade back up above. So that's why I don't use imbalances. But what we have here is we have our previous range that we came out of. We see that price is, this is actually a protected low here. On this little walk up, right? We know that the protected low from this time frame, from this trend going down, the protected high, sorry, is here. from this trend going down. But we know that we trade what we see and not what we think, right? So we understand that within here, we traded up above this previous high, traded back into the range, and then traded up again like that, right? So we have that previous range that's here with the protected low just below here. So what we're anticipating is what? For price to trade back into here, right? In order to provide some upside here. Now, what a lot of people do is when they see price making its way here, they feel intense FOMO after not getting tapped in on something like in this lower portion or something like that, not really catching it. They feel intense FOMO to get in and take out this high. But what we need to understand is that anytime price trades near a structural high, right, we see it trade away from it, and then we see us go to violate it. So for anybody here, what would be your position in structure looking this way? The zones, everything that you have here, what would be something that you would be looking for to take an actionable entry on? Now I'm gonna put the picture, because some of you guys might be, somewhere else at work or wherever. I'm gonna put the picture in the chat, and you guys can mark up the picture in the chat of where you would be anticipating price to go. Like I said, I don't know if price is gonna go down again. I don't know if price is set to go up. I just know that we're at what, the 10 o'clock hour or something like that. Yeah, 10:48. So this is all of us back testing with our different understandings of price and how we're going to, essentially approach the market. At least a tap of the structure. Okay. So one more time, why aren't you including the wick? Because I see you have the body of the down candle along with the low. Why aren't you including the wick? Okay. So let's click through to the next candle. See, a lot of people got the same ideas. Somebody just mentioned a trade up above the previous high there. Yeah, somebody mentioned a trade up above this previous high and then a move back in. Okay. Hold on, let me. There's one person that I said I was going to call on because they asked for more detailed videos, as if the ones on the playlist are not detailed, which I can bet that 95% of you guys here are missing 80% of the information that's actually taught in the playlist. It was something exquisite. Let me see if I can find. And if you're here, you know I'm talking to you. If you're here, let me know. Are you here? You were pretty loud about there not being enough detail in the playlist, so I told you I was gonna call on you. I can't even see the name because when I'm recording on OBS, it blocks out the name. Whoever remembers the person, at them. It was exquisite something. There we go. E, you in here? No, it wasn't Ziga. Ziga's one of the stronger students coming up. The student that mentioned that there wasn't enough details in the playlist. He said the video with more details. I think he meant the shortcuts, but all right. Looks like he's not here. So let's go forward. Oh, exit. Exito Seguro. Okay, we'll move on. So we'll click one forward. Completely forgot. So yes, imbalances I do not use, but what you guys need to understand is in the videos I talked to you guys about this. I said that the first imbalance oftentimes puts in a new high. Now that doesn't mean that we can't come for the low that imbalance put in, the low that the high put in. The low that put in the high. That doesn't mean it can't come back for it, but what we want to make sure is that we're nearest to a zone. So when choosing imbalances, I know some of you guys are still imbalance driven and crazy. You guys are going to learn that with this system, you're either going to get cooked by an imbalance or you're going to, survive with structure. So with this in particular, the first imbalance does very well put in a new high. I always say that in the playlist. I've taught that when I used imbalances. It's really all about your risk tolerance. For me, I do not use them at all because they are not needed at all. But the first imbalance does usually put in a new high. So you see the high with the body closure up here? Where is our new high and low? I just put it in the chat. You guys can mark it up. Where is our new high and low? $16,900. You in the future because all I see is 15 on this price scale. $14,960 is the new high. No. Look at this, guys. If we are trading up above here, right? Down into here, then back up above here, then down into there, and then we just traded up above there. High not confirmed yet. This is the low. And wherever this is going, body closed above the previous high, which gave us our new protected low, right? And our high, wherever it is that price stops and moves back the other way, right? So we click forward. So in this right here, this is the high here, right? This is the high. Why am I calling that the high and not maybe that in there, that in there, that in there? I'm calling that the high because in order for us to have a valid high, we need to close below the previous bullish candle. Y'all see that? There's the close. There's the bullish candle. We need to close below. Remember, I said if your mother told you to use the wick, no. It's the body that dictates whether this high is considered a valid high and whether the pullback that we're looking for from the higher time frame has ensued. It's after we close below that. Now, that doesn't mean take a short. It just means that now we put in a valid high. So there's the previous high. And there's the low. Right? Now, how many people are short from here versus is anyone still waiting for price to trade in here and move us back up into that direction? Remember, we don't know. This is the protected high from a higher time frame. We don't know if price is still looking to head down. This is all the data that we have right here. We don't have anything else. Nothing else to give us any type of confluence in decision making. All we have is our higher time frame, high and low, protected high. We have the higher time frame one here. And we see anytime we get near a structural high, we trade away from it. And then we know we violate it, right? That's just now the simple thing that I mentioned here is also on a higher time frame here. So the one-to-one of that larger zone is here. You see that? The one-to-one of the larger zone is that. So what we sort of understand is that we're working with price looking like, trying to short back into the previous range, but we know the delivery of the one-to-one within that zone is just below there and right back into this part of the zone. But remember, I'm not short because we flipped up above that protected high. Even though the protected high from that 4-hour time frame, or that 1 hour time frame, is most likely 4-hour. That 4-hour time frame, even though that protected high is up there, we know that based on the lower time frames here in the 12-minute, that flipped. Oh, and somebody else said they got an entry here, and it took a 1-to-1 there. Okay. Now look at this. Perfect. Remember how we're all waiting for price to potentially get to that 50% to begin to trade up? This is what I mean by trailing your highs and lows. That is a valid high, but then we put in a low and just trade it up above it right there. That does not mean that over here is not, still a viable option to long. It just means that price is trading into higher prices. That's all. So the way some people look to adjust in this is now they take this previous zone right here, right? And now they want to see price drop back into there and then trade higher from there to at least take out that high first. And this is why backtesting will help you guys to be able to identify this a bit better. So let me just get rid of some of this. We see that high. Talked about this zone right here. We watch price trade back into the zone, right? And when it got to this area of the zone, there's a whole different teaching that's on there. I'm not going to overload you guys today. Video 4 happened inside of here, of the masterclass, the playlist that you guys should have already watched. So you're not going to learn about the 30% or the 70% and you still don't even know how to use the free playlist material. So we tap into there and trade higher, right? Now, what do we have here? This, as I released the video to you guys, and I told you guys that this is what we call the toilet paper people, right? The reason why we call it that is because we're now anticipating price to trade up above here to get them out and then trade back below to get out whatever low that puts in before getting back here, right? That's what you guys are just introduced to in the new videos that were released. You see why the 50% is important? You see why the 1-to-1 happened? The high to the low, the 50%, the 1-to-1, which is the entry criteria I told you guys that you should use if you're learning and you don't know how to consistently make money in the market. So what are we doing now? Where do you guys anticipate this to go? Does this reject from the turtle soup? Or does this make soup with crackers? Hold the turtle. Oh, this is Asia into London. Soup and crackers, like we mentioned. So we mentioned that this gets cooked, right? And then come back to cook these guys. Now, to try and trade this move in here to go back to get that move there, even if it does that, that does not mean that it's short into equal lows. It's short into what is it? Sell side, buy side, whatever it's called. It doesn't mean that it's short into there. It just means that in the particular cycle of the algorithm, right? They look to cook them and then they head back for them here. So what we're anticipating is that after they get back below here, they will bring us back into here for a potential rejection and possible move back up again. Why? Because we flipped up above the daily high now with the body closure, right? So let's leave this here. Let me see what's in there actually. That's there. That's there. Where did that go? That's there. So there's 3 swings in here. Actually, there's 4. So let's click forward. Oh, I forgot to Zoiks. That low there too. This here. The reason why I have this here is because you could still get a bounce into the lower end of this range and it looks like price is trading higher and then it violates that low there. Hold up. What's this? Why am I putting this here? This green line. One to one. Yep. Tapped right into the 50% here. But where do we end up again? Asia. Obviously, in real time, these things are gonna, be a lot more informative. Look at how much times they tried to make it up to this 1 to 1. What did I say about below here, though? I said that there'd be a bounce below here, right? But we'll see if they still make it to the 101 before dropping. Boy, what kind of price action is... Oh, this is still... we'll just speed it up just a little bit. Order field. Order field. So, as you guys were being taught in the beginning with whatever drawings that was up there, we translating it now to real price. We watched that occur. Now, we tapped into the 50 here around somewhere around 2 o'clock, the PM session. And we traded below the PM session in the New York session the next day. But we are still within that previous range. And what do we get? New York trades up to try and deliver it and then trades back down. We end up closing the market without taking the high. So what do we end up having? New York the next day, Yeats beat 1-to-1 order field with a drop going just like this. All because what? All because what, by the way? Our understanding of what happens here. Got in early, cooked them, and then cooked a little more. Equal highs in there. Ends up taking out the lows. But we mentioned down here, we had another bounce into there. That could potentially bring us right down there, right? That's what the drawing showed. Drawings that people hate, but it's clearly cheat codes. So let's go into what we tapped there. The famous fractal. It's this move down into price trading back up above. And even within that fractal, we got a body closure, right? So if we drag the fractal all the way across to the other side, what did we tap? Was it the OT yeet? Nope, because they got yeeted. So what did we tap there? The 50% of the unmitigated fractal below. So remember what we said when it comes to breaking lows? We break lows, manipulate into something, and then we see a move out. Remember that little thing I was drawing earlier? I was like, you get that low, and then you see that up there, and you see that up there, and where all of those different things come from there. Remember that? Real time, or at least back testing, 50% that trades up. And what did we say? The high that puts in the low. Or you could just do 1-to-1. You don't have to. But the high that puts in the low. Now, will that always deliver? No. You might get clapped at break even. It might look like it's going that way and then go right back to your stop loss. But that's where finding contentment in that system matters. So we got that push right back into, what did we say? We said the double top. I think that's what we said, right? We said you might see a double top up there, and sometimes you can get a rejection at that double top. Perfect. Where did you say that? In the free playlist. But I digress. So we have this drop here, right? And this is the last thing I'm going to teach. And then you'll go back to studying and learning. Because Powell is supposed to be speaking today, and I think I'm going to buy some challenges while he's speaking. But you have this drop, right? So this is something in order flow that I want you guys to understand. I don't care about the middle line. It doesn't matter to me. I don't care about that. I like to do what I do. Yeah, that was at it, but no, it just doesn't feel right. So we have this drop here, right? This is a phenomenon that happens in the algorithm. Y'all hear me? This is a phenomenon that happens in the algorithm according to order flow that a lot of you guys get wrapped up with. I already said to you guys, whenever you see those imbalances and people like, oh my God, displacement. That's not what you want to pay attention to. What you want to look at is wherever this low ends up stopping, who is on the other side of this low trying to buy it? Toilet paper people. Me, Jimmy, get out. Toilet paper people. So we're anticipating that move up, the move down, right? Hold on. But then as we mentioned earlier in the video, we want to see something here to bring us back up because it shows us that we flipped bullish on the higher time frame. So we don't need to go to the higher time frame to know that. We can see that from this time frame. So let's click some candles forward. Y'all see them cooking them in here? Chop cheese with them. So this is something that I want to address. This low into this high is not a previous high and low. In fact, that high is not a part of structure. So there's no way that that low could be. Why? Because what did we say? We need to close up above the previous candle. If you don't understand that, watch NQ Market Review on YouTube and watch video 3. You have to close in order for that to be a validated low. And then when we trade up and then we go to put in another low, in order for that to be a validated high, it needs to close below that low that was put in. But the low that was put in has to be validated first. And then the high that gets put in has to be validated the same way we validated the low, right? Boy, I know some of y'all are like, you know what? I'm going to put these videos down and go back to the playlist because what Mrs. Teachers is saying right now is just... So look at this. We have this low below here, right? But what we need to understand is that with this flip right here, right? Remember how I talked about the possibility of deeper mitigations that can happen? Now, a deeper mitigation can happen because we have this last down move in here. Remember what we talked about? The down move and then the zone from the higher time frame. So we got the flip from the zone from the higher time frame, and we got the down move that sent us up, right? Where the flip initially occurred, where it initially occurred, where the flip initially occurred, where it initially occurred, where the flip initially occurred. Y'all hear that? So should we get down in here and we don't take this, what does that mean for these highs that were put in up here? That would mean that the low that put in the high and price traded back to it, if it fails to take that low, then those highs are lunch. Those highs are going to get chopped up. So we saw them get cooked. They thought, oh, sell side taking, tap back into the order block, going back up. Yeets beat that's on the menu all the time for them. But what we understand is that this is approaching the 50%. We know that there are two ways to get involved in this. When you're backtesting, you need to learn about this. The one-to-one is there, right? But you need to understand that until you get your confirmation inside of here to go long, you should not be taking a long just because it came to your zone. But for learning purposes, it might be easier to understand that, to see when they work out and when they don't. But we have that. Let's also address the elephant in the room of the draw bros, the draw and liquidity bros. And remember what I was saying about this last down move. So the risk is reduced in this last down move, but there are times where price can tap right on top of it and leave you. Backtesting is going to help you to learn how to get involved when it taps on top of it and leaves you. It's usually within the 50% of a larger zone that you do not see. You're drawing this out to try to get the smallest entry. I'm not saying that it's going to bounce from here and go for the high. I'm saying that that's something that you should backtest to try to find out how to refine. There's going to be videos released that will teach you how to refine too. But you need to first know how to operate within this, right? It's not every time that you just draw the zone, it taps to 50%, and then willy-nilly it goes to wherever it's going. So let's move a little more candles. Boy, I know everybody's salivating right here, right? For me, if I was looking for a long in here to go up, I would only be taking it to that previous candle's high. Because we have not gotten a protected high and then another low and then trade it back up above the protected high and tap back in to continue. We have not gotten that. So if I was scalping here, then my exit would be short. Likewise, my entry within here I would have found some entry below here to, try to scalp that, because this is the 12-minute time frame. Obviously, you're not going to spend 24 minutes in one area and not see a single entry. Maybe if you're new, but not if you fully understand the system. So we have the draw here for draw liquidity bros. We have the imbalance here. We have the 50% of the previous range. We have the last down move right here, right? All of those different things competing, all of those different things that people believe that it has to be in confluence with their entry, and then they end up, screwing it up. But let's click forward. So did we get that exit up there? No. Are we mitigating this deeper? Yes, but the upside to this is that we're moving into this down move. We're moving into that zone. So guess what? Now if you're refining your entry within here, your entry can be here and your invalidation is lower than your entry being here and your invalidation being here, right? You see what that chasing looks like? Nothing given. All that does is what here? All that does is provide us now with a protected high and a validated low. And the high became protected when we closed below here. And the low became validated when we closed up above the previous candles, the previous down candles high. Remember, when we're bullish is the up candles high. When we're bearish is the down candles high to validate the pullback. So you see, we're still sailing on in there. Now, some people have mentioned that they were looking to go long here earlier in the session. Are you guys still going long from here? Or are you guys waiting to see if the low is taken in order to go long? Too aggressive to the downside. Like a sweep of that low. Main confirmation, waiting for a flip. Origin, wait another 50%. Okay. So we got a mixed bag, but most people are saying, you know, the confirmation factor. That's fine. So remember what I said in the playlist. I said oftentimes if you take a square and put it around the double top, because there's a double top in there, you'll see price reject at the 50% of it. And oftentimes if you take a square and put it around a double bottom, you don't have to see price reject from it, right? I said this in the free course. I know it sounds mind-blowing going through it and backtesting and all that other stuff, but it's literally there for the whole universe to watch. They could save, you know, or eradicate world hunger with that information if they just taught kids in school those things. The exact stuff that's taught in the playlist. So let's drop in there. Okay. Anybody took that little nice little tap there? Where's the 1-to-1-y? Did it get? Oh, look at that! Just tap right in and gave the 1-to-1-y real quick. 1-to-1-y, bring me my money right there, real quick. 1-to-1-y, gone. Now, look at the point value of some of this. This is what, 536, 1536. Sorry, this market close or close to it. Look at that 36-point bounce from this low, from this 50% of the zone that we marked up earlier. Remember what I said? Let price come back to it. So we marked that smaller one up earlier. Now we know that this is usually like something along the lines of the first tap. So we're not immediately saying, yeah, stops behind here. Go with haste. We're not saying that because obviously we know that, you know, we could see some accumulation. What time is this? Look at the time. 15:48. That means market's about to close. Whatever's going to happen here is in Asia. And if they choose to sail up in Asia, you know, we catch up. But this is a move at 15:36 Eastern Standard Time. And that move is done by 15:48. 15:36. The candle closed. So 15:47, you got tapped in. Wait, let me double check. Make sure I'm not. Yeah, 15:47. We got tapped in and we delivered before we got to the next, the 1600. Before we got to the close of the market. Cool. So let's click forward a little. Oh, we know this is Asia, so let's speed it up a little bit. was that? It's midnight Eastern Standard Time. Dearly beloved, we come to you today let me make sure I snap onto this low. With the ye of the universe about to go back that way. We count our swings. We got 1, we got 2, we got 3, we got 4, we got 5. Oh my goodness. Now, that's not saying, let's bring that in. That's not saying that we can't pop this first and then go that way, but that's saying that we're ripe for a turnaround here. Right? And this is 12-minute swings we're using. Ooh. Ooh. Another low there, but we getting a failure to close here. Should we end up trading up above this previous candle's high, that could end up giving us that bullishness to now start making our way up. Now, do I know that entirely? No, I don't. I don't even remember when this was. What's this? June 8th. Oh, no. You know what this is? Oh, boy. So I don't know. I don't remember any of this here. But what I do remember is June 12th, that Monday. I do remember that Monday cooked a lot of people. But we over here in Thursday, so let's not jump ahead of ourselves. Some of you talking about Thursday, the low of the week, and then following Monday, the high of the. Oh no, wait, that's a different week. Let's bring it in. We just gonna follow price, right? Oh, that's looking good. I'd be in a business of looking for some longs to potentially head up to the 926 up here. Let me just bring this over. All right, guys. Real soon I'm gonna start giving little breakdowns on the Apple Vision Pro from the moon, because the quality in being able to record that stuff will show you guys the tiny wicks and like all of the detail you need in price. So I'm gonna do it from the moon. I was watching YouTube and this streamer had said he was sure it was going up. So I immediately immersed myself into the moon. I put myself in the moon image. I was gonna meet him there. Oh boy, it's going up. And he never made it. I don't know what happened. Maybe it was my RAM. And I don't know what happened. So click forward. What time is this actually? Oh, this is London. Okay. What? So now we start counting, right? 1. Boy. Let's see if they come back down and test the zone there. That'd be so messed up if they cook this low first and then go there and still leave that one intact. They did that what was it, Friday that just passed? Or Thursday, one of those, can't remember. All I remember is price these days. What? Boy, they out of here. So, you know, that becomes the larger zone there. You put that as the swing right there. Your validation point is behind the zone. Ooh. Anybody's in? Ooh. Yay! We don't even know what price action this is. Is this the news or something like that? 824. Yeah, this is news. What beep? Y'all see that? And boy, they still waiting on that draw. But look, we have these smaller swings within here, right? Then we have the larger swing there. That one, that two. So we know 4 to 6, right? So means any of our re-entries would essentially be longs, right? Oh my gosh, don't tell me that person balance put a new high. Oh my, come on, don't do that to them. You doing it without them even knowing what happened because they refuse to watch the playlist. Don't even. So let me end this recording right here.